All right, so let's begin the show. And today the focus is on your financial portfolio queries. And to answer all of your portfolio related questions, I have with me Nisreen Mamaji, CFP, MoneyWorks Financial Services. Nisreen, good evening and welcome to the Money Show. For all the viewers watching us live, want to send across your questions, you can do that on our WhatsApp number 8657974571. You can also email us your questions on the Money Show at etnow.tv. So let's begin. And I have my first viewer connected on the phone line with me as well, Krishna Kumar Oza. Good evening, Mr. Oza. Thank you so much for sending us your question. You're calling from?
Rajkot.
All right. I believe you want to know top 3 mutual funds for someone who has a very high risk appetite or risk tolerance, and the time frame is 3 to 5 years. Is that right?
Yes, exactly.
Okay. So I really want to understand. Obviously, we can recommend you these funds, but 3 to 5 years of time frame with high risk appetite in an equity is not something that we recommend to our viewers. So I assume that you have done your risk profiling and so would want to have such kind of a fund.
Kind of fund.
Yeah, I mean, have you done your risk profiling?
No. I have just
Okay,
retired
because
from service.
okay, is this for yourself that you are asking?
Yes.
Okay, so you are retired and you are willing to take the risk involved in an asset class like
Yes,
equity for 3 to 5 years, sir?
yes, exactly.
Okay, perfect. This is what I really wanted to understand so that we can give you a clear-cut suggestions as well. So, Nisreen, I think we are clear on that ground. He's aware of the risk involved in the asset class and so still wants to go ahead with a equity fund for 3 to 5 years with very high risk appetite.
Okay, so again, Mr. Oza, you've already confirmed that your risk appetite is high and you want to go in for high risk. I just like to mention, what exactly you mean by high risk. So in a higher risk product or in a higher risk mutual fund, the volatility will be much higher. Sometimes if there's a correction, you might even see a capital loss. So when you are categorizing yourself as high risk, you have to be aware that there is a possibility that you might see a capital loss for a protracted period of time. Short or long, we can't say. We will only know once the investment is done. In retrospective, only you will know that you saw capital loss for so many days or months. If you're prepared for that, because a high risk investor will have a slightly bumpy ride. But if you are prepared for that, definitely I will share the recommendations for you. So you can go in for a Nippon India Small Cap, ICICI Prudential Business Cycle Fund, and Bandhan Sterling Value Fund. So I've selected 3 slightly higher risk categories and mentioned the names of the funds corresponding to that. So we'll recommend a value strategy, we'll recommend a small cap, and a thematic, which is the ICICI Prudential Business Cycle Fund. So that would be slightly less risky, the business cycle, because it would be more diversified. The small cap would be typically in names that you might not have heard. Smaller cap funds, which are likely to have a price discovery and thereby make you returns, slightly risky strategy. And there's a value strategy also, which would be considered, between aggressive and moderate strategy.
Is there anything else you want to ask, Mr. Oza?
No, can you fund?
Sorry, I did not get you, sir. I think there is some network issue. Can you repeat?
There is a problem. Can you repeat the name of fund you have just recommended?
It is Nippon India Small Cap. Nippon India, we are flashing
Nippon
the
India
names on the
Small
screen
Cap?
as well. Yeah, we are flashing the name on the screen as well, sir. So this show actually goes on the channel's YouTube as well. So you can watch the show on the YouTube as well. Nippon India Small Cap, ICICI Pro Business Cycle, and Bandhan Sterling Value is something that Nisreen is recommending. Thank you so much for asking us your question, Mr. Oza. But Nisreen, taking a cue from his question, I also want you to help our viewers understand the risk involved, post-retirement if someone wants to put their money in equity. And this was a clear-cut high-risk strategy for Mr. Oza. But just in case he wants to play safe, would you want to also recommend him some balanced funds or something in the hybrid category, or maybe something that's more towards fixed income,
So I'm assuming that Mr. Oza has not shared this entire investable surplus. Since he's a
Right, he's
retired
not. Yeah.
person, he might have already, decided himself that he would put about, say, 10 to 15% of his portfolio in a higher risk strategy, and the balance of it could possibly be in a, more safe instruments. So that's what I'm assuming since he's a retired gentleman. But for anybody else in that category, it's quite all right to allocate a smaller portion of the portfolio in a high risk because you have an expectation of high return, which is also true. Only thing is that you have to be prepared for the volatility and wait a little longer. But your larger portfolio, say 80 to 85%, should certainly be in a strategy where you don't expect too much of volatility, you have stability of returns. And if you're making withdrawals, then obviously the corpus is going to remain safe. For that category, for that kind of allocation, dynamic asset allocation funds, such as multi-asset funds, which will include, gold, equity, bonds, and perhaps even international equity, perhaps even silver. So there will be some amount of commodities, international equity, domestic equity, and bonds. There's a certain proportion given to all of these instruments by the fund manager, but it also would keep your corpus as safe as possible. It would give you the flavor of equity so that you can get inflation adjusted returns. Because you also have to ensure that, inflation is 10-year that is wholesale. So you have to also meet those expectations. As a regular buyer of food, of petrol, your normal travel time, of normal consumables, you will be aware that every year we face inflation. All the prices of whether you're buying wheat, whether you're buying milk, whether you're buying fuel, it's all going up, right? So this is in consumer terms, it's nearly going up by 8 to 10%. So you have to make sure that every year what you're withdrawing is also adjusted with inflation. You might be having a retirement period of 20 to 25 years. If you retire at 60 and say your life expectancy is about 85, that means you're looking at 25 years of retirement. So your corpus has to be enough to support you for that period. Also to give you inflation adjusted returns. So every year your withdrawal might also go up by 5 to 10% in order to ensure that your purchasing power remains the same. So that is why one would suggest that during the retirement years, you do keep something in a higher yielding instrument, like Mr. Oza
Right.
also suggested, high risk, but the balance should
Okay.
be in safer products like multi-asset, balance advantage
Right.
category, or hybrid
Right.
equity if you so choose.
Right. Right. All right, so let's move on. I think I have Varsha online with me. Hi, Varsha. Good evening and welcome to the Money Show. You're calling from? Hi, Varsha. Can you hear me?
Yeah, I can.
Hi, Varsha. You're calling from where?
Dubai.
From Dubai. Thank you so much for sending us your question, Varsha. And I believe you are an NRI and you are looking for an investment for almost 15 years.
Yeah, exactly.
Okay. All right. And after 15 years, the amount of money you want to accumulate, corpus that you want to have is almost around 1 CR.
Yes, exactly.
Okay. Have you earlier invested anywhere in terms of mutual funds, equity markets, or any other investment category in India, Varsha?
Not yet. A few investment in equities, near about 3-4 lakhs maximum.
Next month, you will be doing it, 3 to 4 lakhs.
Yeah.
Okay. So this is going to be an every month amount, 3 to 4 lakhs every month, or this is just one-time investment that you are wanting to do?
Okay. Okay, you want to know that? I want to do SIP for 1 lakh every month.
Okay, SIP of 1 lakh every month. I will just note this information down because I did not have it earlier on me. Varsha, just give me a minute. 1 lakh every month, okay.
Yeah.
And any other lump sum amount that you want to put?
Maximum 10 lakhs.
Okay, 10 lakhs is lump sum that you want to put, which is separate from your SIP, right?
Exactly.
Okay, got it. 10 lakh lump sum. Okay, and the duration for your SIP and for the 10 lakh lump sum amount, it's going to be 15 years.
Yes.
Okay, perfect. Perfect. Now I think we have a better clarity on the question and more details, helping Nisreen to frame a better strategy. Nisreen, over to you. 1 lakh rupees a month SIP, 15 years, and 10 lakhs lump sum again for 15 years. The corpus that she wants to accumulate is 1 CR.
Sure. So what one could recommend is that you go in for about 30% towards a large cap strategy, possibly HDFC large cap top 100 fund. Then you put in about 25% into ICICI Prudential small cap, about 22.5% into a focus fund. Recommendation is Invesco India Focus Fund, and a value fund 22.5%, that is Bandhan Sterling Value Fund. So your investable surplus is 1 lakh a month. You also have 10 lakh rupees presently that you wish to disperse, keeping about a 15% compounded annualized growth rate. That is, that we expect that you get 15% per year for the next 15 years. Your expected corpus will be about 76 lakhs. So you might need to increase the SIP figure that you are suggesting about 1 lakh. You might need to take it up to about 1.2 or 1.25 in order to achieve the 1 crore corpus. Okay, so we are giving you an asset allocation, 30% in a large cap fund, 25% in a small cap fund, 22.5% in a focus fund, and 22.5% in a value fund. The names I've already told you: HDFC Top 100, ICICI Prudential Small Cap, Invesco India Focus, and Bandhan Sterling Value. So as I mentioned, 1 lakh, if we're expecting 15% compounded annualized growth rate over the next 15 years, you can review it every 3 years to make sure that you're on track. With this amount of 1 lakh SIP, you would possibly have 76 lakhs in your corpus, but you can review, or you can increase your SIP, or whenever you have lump sums, you can add it in, or every year you can do a step up of the SIP about 10%, whichever strategy works for you, and make sure that you will receive the 1 crore corpus that you're expecting in 15 years.
All right, Varsha, is there anything else you want to ask Nisreen?
No, it's done.
All right, thank you so. Sure. You want to ask something?
No, it's okay. There's some results working here, so.
Okay, I don't think the audio is really clear. Could you please repeat?
Yeah. No, it's okay. I just hear all the details, and I'm going to note all the details.
Yeah. Okay.
Thank you.
Got it. All the best, Varsha. Nisreen, let's move on to next question, which is from Aditya, and he would like to invest for his 1-year-old's child's higher education, and 2 crores in 18 years, and he would also want to know if investing in a single fund like Zerodha Nifty Large Mid Cap 250 Index will be a good option, or could there be any other fund that you would want to recommend, and what should be the SIP amount to achieve his goal?
Okay, sure. So the SIP is about 26,500 at an expected rate of about 13.5%. We're just calculating based on that so that you have a ballpark figure. And so your SIP amount is 26,500 rupees. Instead of going in for just one category of index fund that you mentioned, you could also go in for an HDFC large and mid cap fund, which is in the large and mid space, and Nippon India small cap fund, both of them equal. Okay, so if it's 26,500, just split both of these into 13,250 approximately. And or if you want to do all three, then you can do 1/3, 1/3, 1/3. 1/3 in the index fund that you mentioned, Zerodha Nifty Large Mid Cap 250 Index, HDFC Large and Mid, and also Nippon India Small Cap. The active funds do tend to add value by, sometimes outperforming the index funds, the actively managed strategy. So you can do both. You can do an index fund, which is largely a passive strategy, and you can also do active strategy, like the funds that I have recommended. So try to do a bit of both. I would definitely recommend that you do 1/3 in each of these categories, and around 27,000 rupees is your SIP. You can review it every 2 to 3 years to make sure that you are on track. Depending on the rate of return that you actually get, you might need to increase your SIPs in the earlier periods And then maybe towards when you're reaching your goal, you can reduce your SIP. It's also possible that you meet your goal when your child is only 15 or 16. So all these possibilities are there depending on what the expected returns turn out to be. So it's good to keep a review and make sure that you're on track.
All right, so that's the recommendation for Aditya. But then, a lot of queries these days, Nisreen, are wanting to opt for index fund and have passive strategies. Like, even you look at Aditya's question, his preference was to have Zerodha, Nifty, large, mid cap 250 index. So, we've had this discussion a lot of times, where it is not active or passive, it is active plus passive in terms of strategy and in terms of fund mix that you want to have in your portfolio. But you're talking about large and a mid cap category. For a category like this, should you be having an active fund or an index or a passive strategy would be as fruitful as an index fund?
Mid-cap space, there is a complete possibility that there is some flexibility given to the fund manager to move between large and mid. So therefore, you don't want to lose out on the mid-cap selections that your fund will have. It's very difficult for you as an individual to keep on, churning the portfolio and deciding what kind of, whether you want to just mirror the index. Okay. So in an active strategy, whether it is a small cap or whether it is in a mid cap space or a large cap space, to be honest, the active strategy also has a very large role to play. So that you don't miss out on either of these strategies, I have therefore mentioned that you should do a bit of both. So do the passive as well. You can even go in for the ratio of 50-50, passive and 50% active, or one-third, one-third, one-third in the three categories that I mentioned earlier, so that you have both the favors and both of them add value. It is only retrospectively that we will be able to actually judge and say, okay, this was fantastic. But when you're making the plan, it's better to have a little bit of both and not miss out on the active fund management also. So that is what my recommendation would be, to definitely include the HDFC large and mid also, not to lose out on that, because it is a fund which has performed exceedingly well, compared to the indexes also.
All right, let's move to the last question on the show today, which is from Priyanshi. And a very interesting question, Nisreen. She wants to know a best mutual fund where she can do an SIP to pay her yearly insurance premium for health and life. It's a very new question even for us, because we've been asked to have a strategy to repay the loan, okay, but not a strategy to make your premium payments, that too for your insurance. Can one have a strategy like this? Is it advisable?
Of course, it's a very, very, unique idea. I definitely congratulate Priyanshi for posing this question. And it is an instrument that we as financial planners often use because, the premiums are paid annually. But we always recommend that people save towards those premiums on a monthly basis so that on the date of the premium, your cash flow is not overly burdened. So that's a very good strategy, and Priyanshi has kind of deducted this herself. So definitely congratulations to her for thinking of this and posing this very interesting question. It is definitely a strategy used by our company Moneyworks Financial Services, and I'm sure a lot of other planners also possibly do this. So I have recommended that she use an arbitrage strategy. Currently, the arbitrage spreads are quite decent. As well as you would get equity taxation when you withdraw. So in the shorter term, you would be taxed at 15%. And if you cross a year, if you still have more than a year to pay your premiums, then you would be taxed at 10%. So the Kotak Arbitrage Fund is a very good fund to use for parking, your funds until you have a shorter term goal, which is possibly less than 12 months or even 13th month or 14th month. So it's a lovely strategy and you should definitely use it. And arbitrage is a good plan to use for this particular question that you pose. And I would recommend the Kotak Arbitrage Fund for this, requirement of yours.
But now, how does one allocate the investment amount in order to pay the premium? How does that math work? If by example you could explain that, For example, a total amount of premium is maybe 30,000 yearly. How do you ensure that you do an SIP of a specific amount to get that premium amount yearly?
So this is very similar to what we do for, your tax planning season. A lot of times, you to save tax of 150,000 a year. And most people wake up for your ATC benefits and do it in the month of March. So suddenly in March, you will have your premiums to be paid because you want to take the tax benefit for 80D also, and ATC for life insurance, as well as for all your other requirements of ATC if you've not completed it through your EPF. So instead of burdening the month of March, it's better that you divide your premium as well as all your ATC benefits of 150,000 rupees a year, including your life insurance premium, and just divide it by 12. So you're still in the month of May. So you still have number 5 months. So you have to divide it over the next 11 months so that you've completed this entire requirement by next March, that is 2025. So similarly to what we do with equity linked savings scheme, we divide it over 12 months and you pay 12,500 rupees a year. So whatever your premiums towards 80D, that is your medical, or towards life, ATC, just take the entire corpus, divide it over 12, and then you'll be ready in the month, I'm presuming that it is in March, with that figure. So please follow that strategy. Just divide it by 12 or up to March, whenever your premium due date is, and you will earn a good amount of earnings on it also, as well as you will be able to make your premiums very comfortably without too much cash flow issues.
All right, but then what are the risks involved in an arbitrage fund, Nisreen?
So in the arbitrage fund, basically, it works in the risk-taking part. It works like a debt fund, like a fixed income fund, where you're not actually taking the risk of an equity investor. So the underlying is an equity, but it is always covered. So there is certain derivatives taken on the underlying asset, which is equity, and the product earns through margins of the derivative trading. So it works as far as the risk is concerned. It works like a fixed income or like a debt product. Only thing that the underlying is asset is equity. So you don't have you get equity taxation, but you're not actually taking the risk of an equity investor in terms of volatility or maybe capital loss. So it is an instrument that in the last few years has gained a lot of traction for short-term parking of funds, even for emergency funds, or like you mentioned, for paying your premiums, or for anything where you have a requirement in the next 6 to 8 months. You're not very sure. You have the money now, but you're not very sure how you're going to deploy it. So for a parking instrument, it's really gained popularity, and you can definitely use this arbitrage fund for that purpose.
All right, Nisreen, let's take the last question on the show, and that's from Akash. And he's asking, is there any use in buying an SIP which has a very high NAV already, or low NAV funds are a good opportunity to put their money in?
So the NAV, the net asset value of a mutual fund, represents the price per unit of the fund itself. So it's important to understand that the NAV alone doesn't really determine the suitability of the potential return of the mutual fund investment. So it's not like a stock price, where there is a particular entry or an exit that you wish to go for. For NAV, the day that you enter, from there onwards, you can predict or forecast what your returns are going to be. So, it's not really important. The NAV itself per se is just a figure, and whether it is a higher figure, say 1,000, or whether it is 10, it doesn't really matter from the entry level point of view. So definitely you can, whether the NAV is high or low, that should not be the important factor for you to consider the fund. Rather, you should consider whether you want to go in for that fund, if the strategy is correct for you, if the long-term returns have been according to what your expectations are. You can judge it by the fund house itself, the fund manager. Those are the important characteristics for you to gauge whether you want to enter the fund, rather than the NAV alone. That will have very little bearing on the future prospects of that particular mutual fund.
All right, that's the time we have on the show today. Thank you so much, Nisreen, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but I'm going to leave our viewers with our WhatsApp number and email ID so that you keep sending us your questions. Thank you so much for watching. Goodbye.